Imagine this. You're 55 years old, getting ready to retire, and you log into your investment account. You've been diligent, setting aside money for years, but the number staring back at you isn't what you hoped. Instead of financial freedom, you're realizing that the ETF you chose quietly cost you hundreds of thousands of dollars in missed growth and dividends. That mistake isn't rare. Most people do exactly this. They buy the big name ETFs everyone talks about, thinking they're playing it safe. But here's the truth. Over decades, the difference between a good ETF and the right ETF can mean the gap between a modest retirement and a life where your portfolio pays you more than your job ever did. And the crazy part, you don't need to be rich to make it happen. Just $7 a day, the cost of a coffee and a sandwich, invested in the right fund, could grow into nearly $1 million and spin off over $75,000 every year in dividends by the time you retire. In this video, I'll break down the 5 most popular ETFs. We'll look at their performance, income, risks, and fees. But more importantly, I'll show you which one stands out as the single best ETF to buy in 2025 and why it isn't even close. So if you've ever wondered which ETF is actually worth my money, stick with me, because by the end of this video, you'll not only know the answer, but you'll also see exactly how a simple $7 a day habit could change your entire financial future. So what's an ETF really is? Think of an ETF like a shopping basket of stocks. Instead of buying just one company, you're buying a basket that already holds dozens, sometimes hundreds of companies. That way, if one stock stumbles, the others keep you balanced. And here's the best part. You can buy and sell an ETF just like a stock instantly in your brokerage account. No complicated hedge fund access, no minimums. But not all ETFs are created equal. Some are built for growth, companies reinvesting everything back into expansion. Others are built for income, steady dividends, like getting a paycheck from your portfolio. The ETF we're focusing on today blends both worlds. It grows your wealth while also putting cash in your pocket. When we're judging ETFs, these are the 5 filters that truly matter over decades. Total return, not just share price, but price plus dividends reinvested. Dividend yield and growth, not just how much it pays now, but whether payouts rise each year. Risk and volatility, how it performs when markets crash. Expense ratio, the silent fee that compounds against you. Quality of companies, strong balance sheets, consistent profits, reliable track records. Most beginners focus only on yield. How much will it pay me right now? But that's like choosing a car only because the seats feel comfy, ignoring whether the engine even runs. Yield matters, but growth and quality matter more. Now we're going to walk through 5 popular ETFs, and I'll show you exactly where each one shines and where it falls short. First up, we've got the giant SPDRS and P500 ETF Trust, ticker symbol SPY. Tracks the S and P 500, which means you instantly own 500 of America's biggest companies. Think Apple, Microsoft, Amazon, Nvidia, the heavy hitters. Its expense ratio is just 0.09%. Basically, pocket change when it comes to fees. SPY 10-year returns are about 201%, showing why it's so loved for long-term growth. Dividend payout, around $7.17 per share. Not bad, but definitely not the focus here. Assets under management, a staggering $645 billion, making it the most liquid ETF in the world. SPY is like buying the whole US economy in one click. It grows reliably and has been a powerhouse for decades. But if you're looking for real dividend income, it falls flat. After 30 years of just $7 a day, you'd end up with about $605,000. That sounds impressive, but the dividend income would be only $1,000 a year. That's barely enough to cover your internet bill. Great for growth, weak for cash flow. Next on the list is the Vanguard Dividend Appreciation ETF, ticker symbol VIG. Its focus is only to invest in companies that consistently raise dividends year after year. Expense ratio, an ultra-low 0.05%, keeping costs at a minimum. 10-year return, around 161%, steady and reliable. Dividend payout, about $3.52 per share. Top holdings, names like Microsoft, Visa, JP Morgan, and Apple. Assets under management, roughly $108 billion. VIEG is like the responsible friend in your investing circle. It doesn't chase flashy returns, but it gives you stability and peace of mind. The trade-off is income. If you invested $7 a day here for 30 years, you'd build a portfolio of about $530,000. Respectable, sure, but the dividend income would sit at around $4,000 a year. Maybe enough to cover your car insurance and some groceries, but not enough to retire on. Now let's talk about the Vanguard Mid-Cap Value ETF. Ticker symbol VOE. Its focus is on mid-cap US companies trading below their fair value. Expense ratio 0.07%, still very low. 10-year return, about 86%, which lags behind the bigger names. Dividend payout, roughly $3.72 per share. Top sectors, financials, industrials, utilities, and real estate. Assets under management, around $30 billion. VOE tries to give you balance, some growth, some dividends, some value exposure. Think of it as a sampler platter of undervalued companies. After 30 years of steady $7 a day investing, you'd be looking at around $450,000 total value. And the dividend income? Roughly $22,000 a year. Enough to cover your rent in many US cities, or even fund a couple of nice vacations every year. Solid income, but the overall wealth growth still trails behind. Fourth, we've got iShares Select Dividend ETF. Ticker symbol DVY. Its focus is on high dividend paying US companies. Expense ratio 0.38% pricier than most of its peers. 10-year return around 80%. Dividend payout about $5.15 per share. Top sectors heavy in financials and utilities, plus some consumer staples. Assets under management, close to $20 billion. DVY is all about income. It's the paycheck ETF. Retirees love it because it spits out cash consistently, but the growth just isn't there. If you put in $7 per day for 30 years, your portfolio would grow to about $528,000. The silver lining, you'd be pulling in about $31,000 a year in dividends. That's like having a part-time job paying you every year without lifting a finger. But your portfolio never really snowballs into millionaire status. Finally, we arrive at the star, Schwab US Dividend Equity ETF, ticker symbol SCHD. Its focus is on high-quality US companies with at least 10 years of consistent dividend payments. Expense ratio 0.06%, nearly free. 10-year return, about 114%. Dividend yield, roughly 3.75%. Dividend growth rate, averaging 10.7% per year. Top holdings, PepsiCo, Chevron, Texas Instruments, Merck, Verizon. Assets under management, $50+ billion and growing. SCHD is where growth and income finally meet in one package. It only includes companies with strong profitability, solid balance sheets, and a history of rewarding shareholders. In other words, no junk. Now, let's look at what that $7 a day could do for you here. After 10 years, your account would be worth around $45,000, and the dividends alone would pay you about $2,000 a year. That's like your portfolio covering a month or two of groceries without you touching your paycheck. Fast forward to 20 years, and you're sitting on nearly $290,000 with dividends around $12,000 per year. That's like your investments covering a full year of rent in many US cities. By 30 years, things get jaw-dropping, almost $953,000 in value, and yearly dividends of about $75,000. That's more than the median US salary, all from money working quietly in the background. SCHD doesn't just give you income, it gives you income that grows, turning your $7 a day habit into financial independence. Let's put this into perspective with a simple story. Alex puts his $7 a day into SPY. After 30 years, he has $605,000, but only $1,000 in dividends a year. He still needs a job to pay the bills. Chris, on the other hand, invests $7 a day into SCHD. After 30 years, he has nearly $1 million and collects $75,000 a year in dividends. That's more than the median US salary without working at all. Same effort, same $7 a day, two very different retirements. And here's the kicker. Wait just 5 years to start and you'll cut that $900, the $53,000, almost in half. That's the silent cost of hesitation. As Warren Buffett said, the most important quality for an investor is temperament, not intellect. You don't need to be brilliant. You just need to start and stick with it. And SCHD makes sticking with it easy. Steady income, reliable growth, and rock-bottom fees. And here's the part no chart can capture. Once you see your money paying you every quarter, the motivation to stay consistent becomes unstoppable. That's when compounding stops being a theory and starts feeling like a superpower. So if you want more step-by-step strategies like this, hit subscribe and don't miss what's coming next. And if you're curious, which are the 4 best ETFs to combine with SCHD to get rich faster? Click the video on your screen right now.